You can't waste money if you don't have any. You can't save money if you don't know how much you make or where it's going. In order to get out of debt, get ahead financially and become wealthy, you need to focus on two things: income and spending. Sure, there are other things that matter, like how much you earn compared with how much others earn in your industry or geographic region, but at the end of the day, most folks spend what they make. They might spend a little more than they make, or a little less, but by and large, most people are spending as much as they earn. But before getting into today's topic, do hit that like button and subscribe if you haven't done it yet. Let's start, shall we? Most folks spend what they make. If you spend more than you earn, it's not a good idea. It's better to spend less than you earn. If you save the difference, it will enable you to invest in something that will make the money work for you instead of just giving it back to someone else by paying off debts or buying things on credit. You can use the money to invest in your own business or buy into an existing business, such as stocks, which will make more money for yourself over time. That's why it's such a struggle to get ahead. You can have a great income, but if you're spending all of it, or more, you don't have much extra to invest, and that keeps you from building wealth. How do you get ahead? You need to master the 4 pillars of wealth. 1. Spend less than you earn. Keeping track of your finances is the first step to managing them. If you don't know where your money is going, it's impossible to make any sort of plan for your future. Tracking your expenses helps you figure out what exactly you're spending and why. This can help you create a more realistic budget and understand how much money you actually have at any time. You should also keep track of all income and expenses in one place so that all numbers are easily accessible, and preferably this will be on a computer or smartphone app. 2. Save 10% of your income or more. It's not about how much you earn, it's about how much you keep. It is extremely important to start saving as soon as possible. The magic of compounding means that the earlier you start saving for your retirement, the more money you get to take advantage of this magic. The power of compound interest means that if you save $100 today and invest it at 10% annually, then by 50 years from now, that initial $100 will grow into $240,000. That's why you need save 10% or more. 3. Pay off debt as quickly as possible, all of it, if possible. The phrase debt is a burden is a common way to describe debt, but the truth is that it's even more than that. In fact, debt can be a sign that you're not doing any of the following: saving money and investing in your future, living below your means, or using credit responsibly. And because we're talking about how to get out of debt faster, let's be clear, paying off debt isn't just about getting rid of those pesky monthly payments, it's also about building wealth and financial security for yourself and your family. Debt is powerful if you have the brains and discipline to use it wisely. Debt can be used to buy assets like a home or car, which will appreciate in value over time. It can also be used to pay for things that are worth more than their cost. For example, let's say you're a real estate investor and you want to buy a piece of property for $100,000 but don't have enough cash on hand for the whole amount. You could take out a mortgage with your bank or credit union for $80,000, then borrow an additional $20,000 from another source such as friends or family members at 5% interest rate, paid monthly. This would help cover the costs of closing escrow as well as materials needed for repairs after purchase date, so no money had been spent yet. You could even invest some profits back into this project. For invest wisely and regularly in a diversified portfolio that suits both your risk tolerance and long-term goals, such as retirement or college education for your children or yourself. Diversification is the single biggest factor in your investing success. It means owning different kinds of assets, like stocks, bonds, gold, and real estate. Diversifying your portfolio means you're less likely to lose money if the stock market drops. It's also easier to beat inflation with a diversified portfolio than it is with an all-stock or all-bond portfolio, because each type of investment has its own rate of return. As stocks have higher returns than bonds but come with greater volatility. Bonds have lower returns than stocks but come with less volatility. Gold has almost no price fluctuations but produces no income. Real estate provides steady income but isn't liquid, meaning it can't be sold quickly. You should start investing early, ideally before age 30, while interest rates are still low, so that compounding can work its magic over time without being overcome by inflation, which erodes the value of money over time. The bottom line is that saving money is not a one-size-fits-all kind of thing. You'll need to figure out what works best for you. Maybe that means following the tried and true advice of saving 10% or more of your income, paying off all debt as quickly as possible, and then some, and then investing wisely. Or maybe it means something else entirely. But just remember, no matter what route you take toward financial freedom, there's always room for improvement when it comes down to how much money we keep versus how much goes out each month. Well, thank you so much for watching. I hope you found it both interesting and helpful. As always, if you haven't, please press a like and subscribe buttons. Have a great day and see you in the next one.